All right, John, we're back. This is after the election. We're recording on a Friday. Tuesday was a big day. This is taking stock number 6, and everyone wants to know what's going on with the market after the election.
Well, I think like we discussed in the economic update that we held recently, it's a treacherous idea to try and predict the outcome of the election and what that might mean for markets. Because broadly speaking, although elections matter, it's not that they don't matter. It's just that 1,000 other things also matter.
Right.
And I know, the two dominant narratives I heard were if Biden gets elected, stocks are going to tank, right? And if Trump gets elected, stocks are going to tank. And of course, we had this outcome. We've got a split Congress, probably. Results are still to be, defined. The White House is looking like it's going to go to Biden. And here stocks are up and up solidly, both going into the election and coming out the backside. And so, again, I think that the lesson to be taken from this, just like the lesson, we got from when Obama was elected, when Trump was elected, stocks move in ways that have nothing to do with the election results. And that's, again, what we're seeing.
Right. Yeah. I read this really good paper. I know you're slogging your way through it, but it was talking about the effect of stimulus on the economy, not only on the economy, but on the market. And the title of the paper is Upside Down Markets.
Mm-hmm.
And oftentimes I've heard this, since I started in finance, the term cash on the sidelines, right? Which is supposed to describe when the market goes down, all of a sudden there's more cash in people's accounts that's pent up demand that'll come back into the market.
Well, people sold out and they're waiting.
They sold out and they're waiting, and there's cash on the sidelines that could come back into the market. And fundamentally, that isn't how accounting works, right? You and I, if I buy a stock from you for $100, it goes from my checking account into your checking account, same amount of cash.
So when people sell out of the market, they had to sell to somebody.
Exactly. And that's just money changing accounts, basically. Mm-hmm. But what's interesting about this paper when I read it was fiscal stimulus is truly the only time that there's cash infused, or the paper describes cash and bonds equivalently, into the system. And the really interesting takeaway is he broke down each country's aggregate stock versus bond mix. So instead of looking at, an individual investor, what if we looked at every American, and it was something like 45% of our wealth is in stocks, but in Japan it's something like 25% is in stocks. So these risk attitudes differ across countries. But the interesting part was he was saying if the stimulus is big enough, those things always kind of move back to those attitudes. So if all of a sudden, instead of 45% stocks, there's all this extra money that is truly created, if that percentage goes down to 40%, they always kind of come back to that equilibrium. And so his point was, and that might be kind of what we're seeing with the stock market, is that those dollars are going to kind of move up and eventually drive prices higher in the market.
Yeah. So then the big question is around stimulus is really what are the sort of the longer term effects? So, when these stock prices go up, then what, right? And
right.
How does this cash get back out of the system? You can tax it out. Is probably I would guess, going to be the most likely way that it comes back out of the system. So, when we all talk about will tax rates be higher in the future, well, this would suggest there's a good chance of that, especially if we see some inflation.
Yep, exactly. It was a really interesting paper. So another question we keep getting, and we've been talking about in our investment committee, is ETFs. So exchange traded funds. Can you take a minute and describe what an ETF is?
Sure. Yeah. An ETF. So if you think about the world of, there are individual stocks, and then there are groups of individual stocks, mutual funds, and they each have their own properties. So stocks, you can trade a stock throughout the day, right? You start in the morning and the price may be down here, and you could execute a trade down here, but then that stock price moves throughout the day, and you can trade that stock throughout the day. A mutual fund is a little different. Of course, that's a bucket of lots of stocks.
Yep.
And that just trades at the very end of the day. At the end of the day, you place a trade to sell out of your mutual fund. Well, we're going to wait till the end of the day, see where the closing prices are. That'll determine the value of that mutual fund. Mm-hmm. So they each have their own characteristics. An ETF has the characteristics of stocks in that it can be traded throughout the day, but it has the characteristics of mutual funds in that it's a pooled investment, right? So you get a whole bunch of stocks in effectively like a bucket.
And a lot of people, what's probably the biggest misconception you think as far as what an ETF is?
Well, I think the biggest one, probably two. One is that they are, like incredibly tax efficient, right? And I think, and that can be the case, but it can also, it's not the case for all ETFs, and it's not the case, for like the most, an ETF where they're not truly managing the taxes, and we'll talk about that in just a second. But there's a nice mechanism in ETFs to manage taxes, but an ETF that doesn't focus on that can be less tax efficient than a tax managed mutual fund. So the difference between the two is probably not as great as some point out. The other thing would be, I think a lot of people, when they hear ETF, they think index fund, right? This is going to be a low cost product, cover the market. Whereas what's the truth is that there's probably more new ETFs every day than any other product. And you can buy one that focuses on Turkish stocks or, individual commodities, or, I mean,
there's a lot of thematic ones.
That's right.
Clever ticker symbols too.
Yes. Yeah. You want to give us some? No. We'll do that next time.
Yeah. And the tax part of it too is interesting in that I think one misconception I get from clients is that ETFs save taxes. Right. And really it's, if you have the exact same, I mean, at the margins, you could make really different things, but simplistically, it allows you to control your taxes. So it defers them, and the only way that you really save money is if you shift into a year or a situation where your rate is going to be lower. So a mutual fund will kick those distributions out to you. That will be added to your basis. So the net total tax would be the same. The amount of the distributions would, or the gain, you're just trying to find the years where maybe you were in a high income tax bracket and you went all the way to a low income tax bracket, or, heaven forbid you pass away, everything gets a step up. Those are the ways that ETFs really kind of shine relative to mutual funds.
Yeah. And that mechanism really is kind of interesting. So if an ETF owns Microsoft, you bought it at, or the ETF bought it at 100, it's now at 200, there's that gain. If a mutual fund was in that position, they could sell Microsoft to get another position in, and that $100 gain would get pushed out to the client. Whereas an ETF can say, you know what, I'm going to take Microsoft and swap it for JP Morgan.
Yep.
And, it's not that you don't owe the tax, it's just embedded in the ETF, right?
Yeah. And there's a big white paper. It's called the Etf Tax Loophole. That simplest way to describe it is they don't ever sell, not ever, they don't generally sell the securities for cash. They figure out a way to swap equivalent value between providers. So you're not actually selling it and then repurchasing something. Be like you sort of, trading me your car, 1.5 of your cars or something.
But the bottom line is that as a long-term investor, there are opportunities to think about taxes and to save, both with mutual funds and ETFs.
Oh yeah.
Or at least defer them. That's the case.
Yes, defer. So,
What else do we have to talk about?
Well, I found another antitrust thing, which seems like we talk about quite a bit.
Oh,
There's a lot of, yeah, the Visa thing. So Visa purchased a company called Plaid, and Plaid is a tech.
Not Plaid Pantry, not the mini mart in Portland.
No. This is a fintech company that makes it easier for institutions to share information. So some of our clients at the bank use our financial planning software where they can link their accounts with other institutions. And people are probably familiar with Mint, right? That technology, each site that company goes in, and it's called screen scraping, where they sort of know where the data is and they go and they pull it back. But that's really cumbersome because if the client changes their password or something on that website changes, confirm your email address, it kind of breaks everything. And so Plaid is this platform. It probably does more than this, but really simplistically builds a permanent connection between those institutions so that you authorize at one time and then you can change your password or whatever and everything's connected. Well, Visa decided to purchase Plaid, and unfortunately the CEO of Visa on a conference call or an interview or something said that we had to do this to protect our business and our market share when it comes to debit card transactions. Unfortunately, the Department of Justice, or I don't know if it was DOJ or the SEC, they didn't like that. And so they filed an antitrust lawsuit, which is kind of the opposite of what we've been talking about, where Apple or big tech companies are sort of getting some heat. Well, Visa is sort of one of those older companies that's trying to protect its moat and buy the disruptors before they, ruin their businesses. So
if you're going to buy some competitor that scares you, don't say that. Say
right,
like, I want to buy them to help make them better and provide more to clients.
Right. The tech CEOs have generally positioned as why it's better for the consumer,
right?
Whereas this guy's statement was, I'm trying to preserve our quasi-monopoly, which doesn't go over quite as well. So,
right.
But
well, the whole world of tech is interesting right now. I know the portfolio management department is doing a lot of due diligence and looking at the potential of adding some funds, probably relatively small allocations to begin with, but some funds that really look at or try and invest in companies that have the potential to really disrupt markets.
So like the plaids of the.
Exactly right. Yeah. Or just sort of taking sort of older business models and using technology to do them better, faster, cheaper.
Mm-hmm.
And there's, although sometimes it feels like everything is moving so quickly now, I think these applications of technology are only going to grow, and the opportunities with them, probably less so in sort of the really big areas of tech. These are big aircraft carriers now that are going to be tough to turn, but some of the medium-sized companies, there's just a lot of just amazing applications of technology, both to old and new business models. And I think that's going to present lots of really interesting areas for investment. Some of those will be added to the portfolios shortly.
Yeah, when I think of one of those, when we were going through that process, Shopify.
Mm-hmm.
Right. Everybody thinks kind of Amazon. Well, Amazon's, going to eat the world. Shopify helps people. I'm sure there's some interplay between Amazon and Shopify, but it's an e-commerce tech company. It's not just Amazon. So those types of companies that, haven't achieved that level of success, but
I think it was Jeff Bezos who said, even Amazon, right, the big disruptor, will be disrupted, and it'll be just interesting to see who's doing that next round of disruption. So.
Right. What technology has to come about where Amazon's disrupted?
Right.
Amazon's a function of the internet. Are we going to have, nobody Neuralink or something where you're ordering things through telepathy. I don't know the big
And
breakthrough.
it's so hard to envision it, right? But it was really hard to envision a day when Exxon wasn't, in the S&P 500 and here.
If you get a chance, you should watch. There's a David Bowie interview from 1999, and he predicts almost everything about the internet. It is absolutely wild. He's talking about marketing, sort of false information spreading, and ad models and the perils that come with it, and the great parts that it was like he hopped in a time machine. So
are you sure it was David Bowie?
Yeah, 100%.
Ground Control to Major Tom, David Bowie?
Yeah. Yes.
Awesome.
So,
all right. Well,
all right.
I'll go watch that right now.
All right. Sounds good. We'll
Thanks
see
for joining us, everyone.
Yeah.